S&P 500 index shows strength with bullish reversal. In the past week, the S&P 500 index, SPX, has shown resilience and gained 1.32% after a bullish outside reversal day. This positive momentum is supported by the NYSE Advance-Decline Line, which is near its all-time highs. While short-term indicators indicate some weakness, the long-term chart analysis suggests that the bull market may still have room to grow. In the next few minutes, we will discuss the recent performance of the S&P 500 index and discuss the potential implications for investors. S&P 500 index performance. Last week, the S&P 500 index experienced a minus 0.50% loss, but a late-day rally on Friday, accompanied by double the normal volume, helped mitigate the decline. This week, the index rebounded strongly, gaining 1.32% after a bullish outside reversal day. The Nasdaq 100 index also performed well, adding 2.5% for the week and closing at new highs. These gains are encouraging. However, there are some concerns about the overall strength of the bull market. Weakness in indicators. While the SPX and NDX reached new highs, the iShares Russell 2000 Small Cap ETF, IWM, triggered a sell signal, indicating weakness in small cap stocks. Additionally, the NYSE Advance-Decline Line, which measures the breadth of the market, is lower despite the SPX's rise. This divergence is often seen as an early warning sign of potential market turbulence. While these indicators do not definitively signal the end of the bull market, they do raise some red flags that should be monitored closely. Long-term outlook. Despite the potential weaknesses in some indicators, trusted economists and market analysts believe that the bull market may still have room to grow. Yardeni research suggests that the positive earnings breadth of the S&P 500 indicates that we are still in the early stages of the bull market. Andrew Slimon, Senior Portfolio Manager for U.S. Equities at Morgan Stanley Investment Management, also believes that it is still early in the cycle for equities. He suggests that the fear of missing out, FOMO, has not yet kicked in for many investors, who are content with the yields from cash-like securities. However, he predicts that if the S&P 500 sees double-digit percentage gains in 2024, it may attract more enthusiasm towards equities. Economic reports. Several economic reports were released this week, providing insights into the state of the U.S. economy. The ISM Manufacturing PMI showed another contraction in manufacturing activity, while the ISM Services PMI soared to its highest level in 9 months. Private businesses added fewer workers to their payrolls in May, and mortgage applications declined due to concerns about elevated mortgage rates. The trade deficit widened, and the number of people claiming unemployment benefits increased. However, the U.S. economy added more jobs than expected in May, and wages saw a significant increase. Conclusion. The recent performance of the S&P 500 index suggests that the bull market may still have room to grow. While there are some weaknesses in certain indicators, the positive earnings breadth and the potential for double-digit percentage gains in the S&P 500 in 2024 indicate that we may still be in the early stages of the bull market. However, it is important to monitor these indicators closely and stay informed about economic reports to make informed investment decisions. The information provided here is for informational purposes only and should not be considered as financial advice. Investing in the stock market carries risks, and individuals should conduct their own research and consult with a financial advisor before making any investment decisions.
As always, do not forget to like and subscribe to our channel, All Things Money, to see more content like this.